In Southern California, 5 wildfires are still burning. They have spread to nearly 30,000 acres, damaging or destroying over 10,000 homes and businesses. 180,000 people are under evacuation orders, and so far, 10 people have died. The LA wildfires are on track to being one of the costliest natural disasters on record. Current estimates from Accuweather seeing the losses between $135 billion and $150 billion. This will likely add stress to the already fragile insurance market in California. Last year, 70% of State Farm customers in Pacific Palisades lost coverage. Private insurers like State Farm, Allstate, and Farmers Insurance have stopped selling new property and casualty coverage in California, saying that the cost to underwrite policies is too high given the number of natural disasters in recent years. Joining us now for more, we want to bring in Cathy Seifert. She's the Vice President of CFRA Research. Cathy, it's good to see you. When you take a look at what is happening, the tragedy of the loss right now in California, the fact that the wildfires are still burning, talk to us just through how you're assessing the economic damage and ultimately what that spells out here for the insurance industry.
Sure. I mean, there's a lot to unpack here, but let's first talk about the initial assessment. And right now, as of this morning, the largest fire is only 6% contained. So I think loss estimates, insured loss estimates, and I think it's also important to differentiate between total economic losses, which will be in excess of $100 billion, versus insured losses. And there are insured loss estimates, which basically means how much insurance companies are going to be paying out. The ranges now look to be, 20 to 30%. I think ultimately it's going to be higher than that. And so, we have obviously this big catastrophe that was honestly, I don't want to say, obviously it's shocking and a surprise, but a lot of people in the industry were not overly surprised by this. We have that issue. The insurance industry does have the capacity to address these claims. The issue, though, is a crisis of availability for homeowners in California, and there are a lot of issues driving that.
And so, Cathy, how does this change, to the second part of Shauna's question, the future of insurability in certain regions that are more prone to disasters like this?
Well, climate change, which we have an incoming administration that doesn't want to address, is going to increase or decrease the availability of an insurance, increase the crisis of availability, the protection gap, and ultimately the costs of climate change are inflationary. As it relates to the California insurance market, interestingly enough, I mean, there has been an issue in California because California regulators mandated that companies use a retrospective rating process, which means they had to look back historically at claim trends when they were setting rates. A lot of other states allow insurers to look prospectively and to model the likelihood of claim cost inflation when setting rates. Starting this January, California finally adopted a prospective rate setting methodology. The combination of that, plus the fact that very few carriers want to do business in California, means that homeowners in California are facing massive increases in their homeowners insurance coverage.
And Cathy, for our audience, just from an investor perspective, what insurance stocks have the most exposure or at most risk here of what is playing out in California?
So State Farm is the largest homeowners insurer in California, and that's a mutual company. A lot of the publicly traded insurers over the last decade or so have reduced their exposure. Within the publicly traded space, Allstate has exposure, Chubb has exposure, Travelers has exposure, and Cincinnati Financial, a regional carrier, has exposure. My sense is that it will be manageable. And I would also point out that last year we had an elevated level of catastrophe losses, 140 insured catastrophe losses in the U.S. Property casualty insurance stocks were among the better performing financial sector names last year, largely because these level of claim costs give the industry pricing power. It's a little counterintuitive, and my sense is today the group is going to be down as people assess the level of claims and the implications. And then once people get a better sense of how much this is going to cost, they'll, assess that and then move forward with the likelihood that this will be another pricing catalyst for the industry.
Cathy, thanks so much for taking the time here with us, helping us to the best ability break down some of the devastating story that continues to unfold in front of our eyes. We appreciate it.
My pleasure.